Hello and welcome to the Of Interest podcast. I'm Gareth Vaughan from interest.co.nz. On Wednesday, Statistics New Zealand released the latest quarterly Consumers Price Index, measuring the rate of price change of goods and services bought by New Zealand households. It shows annual inflation of 4.7% in the December quarter, down from 5.6% in the September quarter. That's also well down from the 32-year high of 7.3% back in mid-2022. So is the New Zealand inflation war being won, or are there still major battles to come? And what might weakening inflation mean for the Reserve Bank and the direction of interest rates in 2024? To discuss this and more, I'm joined by Kiwibank Chief Economist Jarrod Kerr. Hi Jarrod, Happy New Year, and welcome to the Of Interest podcast.
Yeah, Happy New Year, and thanks for having me on.
Look, so just to begin with, what's your overall impression of the latest CPI?
So the headline rate, the rate of inflation has come off, which is great. You know, we had inflation running at over 7%, it dropped to 6%, 5%. Now we're in the mid-fours, which is good. We are winning the war on inflation, but there are a few battles ahead and a few wins that we need over this year. So we think inflation will fall to 3% quite quickly, but the move from 3 to 2 might be a bit awkward later this year and into next year. The message for, I think, households and businesses out there is that the cost of living crisis is getting better. So inflation rates are coming down at a time when income growth is lifting. So I think by the end of this year, we'll see that incomes in the economy will be growing, 4 or 5%, and hopefully inflation's back closer to 2%. So that'll help with household budgets.
Absolutely, yeah. Obviously, this CPI breaks down inflation into the tradables and non-tradables, with the idea being that tradables are goods and services that can be substituted with imported or internationally available alternatives. Non-tradables are goods and services that can't be. So there's a bit of a discrepancy, or quite a big discrepancy, between those two groups, with the tradable inflation rate at 3% now, which is really encouraging. However, the non-tradable rate was at 5.9%, which was still a bit higher than the RBNZ had been expecting. I think it was expecting 5.7%. And the RBNZ, as we'll get into later, is very fixated on non-tradable. So why is that non-tradable inflation rate proving more stubborn than tradable inflation, and what is really driving that?
There are a few drivers there, and you're right, non-tradables is more important for the central bank because those are the prices that they have the most influence on, and non-tradables, as you say, is running a little bit above what the central bank thought it would be. And indeed, we've been surprised by the strength of non-tradables, that domestically generated stuff. A lot of it's coming out of housing-related costs. So construction costs have risen again, and we've seen insurance premiums picking up, and that'll continue. And what we've recently seen is quite an uptick in rents. And we're putting this down to the migration boom that we've had. We had a record intake of migrants over the last year. The first thing you do when you go to a country is try and find a place to live. So, that's having an impact on rents. I think it'll also have an impact on house prices for those that can come here and afford to buy straight off the mark. But we are adding people, we are adding population to an economy that's already short housing. We don't have adequate housing supply. Inflation in these parts of the economy are higher than would otherwise be the case. These migrants are coming here, they're setting themselves up, they're buying bits and pieces, and that's just putting extra pressure on everything.
Yeah. The really interesting aspect of this to me is that this non-tradables area is the area where the RBNZ supposedly has more influence than obviously importing things like oil and other goods that we import from overseas. But then when you talk about some of the key drivers there, obviously insurance premiums, I think we had 11.9% annual rise in insurance, and then the council rates and related issues 9.6, nearly 10%. So these are obviously areas, and obviously rents you talked about, and migration driving that. So these are areas where probably public policy drives what happens more than the RBNZ can. And insurance, I guess, private sector companies are setting premiums based on their own costs and profit expectations. So, I mean, to what extent can the RBNZ really influence this area?
Well, these particular areas that you mentioned, not a great deal. To be fair, I mean, if we're looking at why insurance premiums are rising, climate change and the savage weather that we've seen, obviously the cyclones of this time last year is an excellent example of more violent, more frequent weather events. Wiping out crops and houses and having a big impact on places like the Hawke's Bay. I went to the store the other day and no apples. So there are pretty big impacts on weather alone, and these insurance companies are having to adjust their premiums. That will continue, and I think it'll get harder to get the sort of insurance that we're used to. And I think that if you're in a low-lying area, in a world of rising sea levels, or if you're in an area that gets battered by weather events, not only are your premiums going to go up, but you may start seeing that there are exclusions on your policy. So you might have insurance on your home, but it excludes flood. You can get insurance for everything you don't need, and you can't get insurance for precisely what you do need. So that worries us how that plays out. And from a bank's perspective, can you then put a mortgage on a property that doesn't have insurance? So there are some issues coming through just on that front and on the climate change side of things. And then you mentioned, councils. Well, councils and governments have underinvested in this country for decades. It's sad, but it is what it is. And, we're seeing the issues on the back of that, whether it's a lack of water supply in major cities or sewage making it into the beaches here in Auckland. It is a bit of a disgrace, but, there is a lot of investment just to get us back to where we should be. And that costs money. Councils are up to their eyeballs in debt. They can't afford it. So there's a lot of investment that needs to be done, and a lot of investment that will need to be done at the same time, which, again, coming back to inflation, all of these things adding up. It's more inflation than would otherwise be the case. Very hard for the central bank to control that.
Yeah, and look, I mean, obviously that the net zero push that New Zealand and many other countries are getting underway on is a decades long process to, I guess, wean ourselves off fossil fuels. That it feels like that is likely to be an inflationary process as well. You're saying that you are anticipating the RBNZ will inflation will get back to within the RBNZ's target, that 1 to 3% target, and obviously they're seem to be more set on 2% midpoint of that. But I mean, medium to long term, how big of a challenge is it going to be for the RBNZ and other central banks to meet these targets in this world that we're talking about with all these costs?
Yeah, potentially a lot harder.
And we haven't even mentioned all the wars and uncertainties, geopolitical uncertainties out there. We can come to those later, perhaps.
Yeah, well, they're all adding to inflation pressure. What you mentioned, whether it's the climate change, moving from fossil fuels to renewables, and in some cases waiting for technology to get to a point where these things become viable. It is inflationary, right? It is inflationary. Everything that we need to do in that space is inflationary, at least to begin with. But the weather events themselves, they've been more frequent and more savage. And having these weather events popping up every year, is going to add inflationary pressure that otherwise we wouldn't have had every year. And I think, central banks are supposed to look through these sorts of weather events, but when they're happening at a much higher frequency, at some point it becomes, just part of your makeup of where you think inflation's going to average out over the future, and it's going to potentially be a lot harder to keep inflation below 3% with all these things going on.
So that then, I guess, brings us on to whether you change the central bank's mandates. Do you have any particular view on that at this point?
Yeah, I do. Look, I think if we do wake up in a few years' time and realise that keeping inflation between 1 and 3 in a world where climate events and the transition to different energy sources proves to be quite inflationary and quite persistent, then the argument will move from getting inflation back down to 2% and averaging it there to maybe we soften that stance a little bit and allow inflation to run slightly higher. From the Reserve Bank's point of view, I could imagine that they could relax it from 2 to say 2.5, maybe as high as 3. From their point of view, it's all about expectations. So as soon as you lift your inflation mandate, well, then people just expect inflation. So somewhat self-fulfilling. They'll be wary of that, but it might be necessary given the inflation pulses that we'll be getting from climate change-related issues or a lack of infrastructure and trying to catch up. That's all inflationary stuff.
Yeah, no, absolutely. And look, just on sticking on the inflationary point for a minute. Now, we have obviously seen inflation rates in a lot of countries around the world come down from, what were decades-long highs. Notably in the US, has been, they came down a lot quicker than we did, but they seem to be sort of not quite where they want to be yet either. But I'm just interested in your take. I mean, obviously with central banks like the RBNZ hiking, their I guess base interest rate, the OCR, official cash rate in New Zealand's instance, from 0.25 up to 5.5%. To what extent is that the reason that inflation has come down, or is it more to do with the fact that obviously through the COVID pandemic, the global economy was disrupted probably to a greater degree than it has been maybe since World War II. I mean, maybe not, but certainly massive disruption. And that has to some degree normalised, although obviously we've got factors like what's happening in the Middle East at the moment that are maybe pushing back on that. So, to what extent have the rate hikes pushed inflation down, and to what extent has it been just global normalisation going on?
Oh, it's both. Definitely both. So we saw quite a synchronised response to the pandemic. All central banks slashed interest rates to record lows, lower than the rates we saw in the 1950s. These were the lowest, interest rates ever printed. And then that overstimulated, it pushed demand too far at a time when supply was being restricted by COVID and the lockdowns. So we ended up coming out of that COVID experience with quite very high rates of inflation. Let's not forget that the housing market went crazy as well. We saw a 45% gain in house prices in just 18 months. So, central banks printed a lot of cash, and it ended up in many asset markets. House prices are, the classic example in New Zealand. And then they all decided, well, actually, we need to get on top of this inflation beast that we've created. And our central bank was the first, or at least one of the first, to start lifting interest rates, and they lifted aggressively. And we've seen house prices correct. So I think the Reserve Bank's actions with the lifting the cash rate here, but also playing around with LVR restrictions and then the government playing around with interest deductibility, all of these things came through triple CFA and really sort of restrained the credit availability, the ability to get mortgages. So that had a big impact. So I definitely what the Reserve Bank has done in slowing the economy down, particularly housing, but also, recently the cost of living crisis and now the rapid rise in interest rates is really slowing down, the consumer. And we've seen, consumption really come off. We've had a couple of quarters of contraction, and we might get a couple more. So their policy response was very aggressive and heavy-handed, and it has had an impact on the consumer in New Zealand. So yes, that they have had an impact. But then equally, we saw shipping costs return to normal at the end of last year. That's a global story. Costs of imported goods normalised quite quickly. That's an international story. So we've actually seen more, disinflation coming through via international prices when compared to local. So both are helping the inflation outlook.
Okay. And in terms of the Reserve Bank, so we've obviously got a speech next Tuesday from the Reserve Bank Chief Economist, Paul Conway, who's also a member of the Monetary Policy Committee. What do you expect to hear from him, and what do you want to hear from him?
I think we have to have an acknowledgement that the overly hawkish commentary from November is no longer. When you look at what they told us in November, that they said, look, we've basically got zero tolerance for upside surprises. We've had nothing but downside surprises since that statement. So the big ones were the GDP report, which came out much weaker than what the central bank. So that's, our economic growth, our economic activity is far lower than they had anticipated. That was also reflected in the government's mini budget. So the economy is basically 2% smaller than what they thought. That's quite a lot. It's a big downward revision. That's a lower tax base. That's a lower level of economic output compared to the RBNZ's models that they gave us in November. So I think they have to go into their February monetary policy statement updating the numbers, revising down their activity, and therefore I think revising down their inflation pulse. They were surprised on the downside on headline inflation. They thought it was going to be up 0.8. We got 0.5. They thought the annual rate would be at 5. We're at 4.7. So there has been headway made, even though it was mostly tradables. And I think you just have to get a softening. They gave us a clear indication that if anything goes wrong to the upside, that they will hike again, and they gave us like a 60% probability that they would hike again. I think it was wrong at the time, and it's been proven wrong now. And I think Paul may hint that the suggestions of another hike in this cycle have evaporated, but equally talk of rate cuts. I think they'll be coming out saying that's premature. That's a conversation for later in the year.
Yeah, I mean, interestingly, with the official cash rate at 5.50%, it's been there since May last year now. So they have held it at that rate for some time. As you say, I mean, they have retained a hawkish bias right up to the end of last year. The financial markets, though, have been pricing in cuts this year to the OCR. We obviously get the next review of the OCR on February 28th, so we've still got a month to go before we get it.
Yeah.
By that point, and we are looking into a bit of a crystal ball, but with what we know based on where we are today, what would you anticipate them to say on February 28th?
I think they have to acknowledge that the economy is weaker than what they thought. That's good news, because they're out there wanting to soften the economy to get inflation down. So I think acknowledging that the work that they've done to date has had an impact. That's probably the first thing. And then just revising their forecasts and saying, hey, look, there is probably less inflation pressure in here than what we thought in November. And that's a big move in itself. It's not a full pivot, but it's moving away from, threatening rate hikes to just saying, well, we're on hold for a while. And then at some point later this year, they'll move to start cutting rates. And we're seeing this across central banks. So the Fed, you mentioned, they put a dot plot together, which gives us a guide as to where the different members of the Fed think interest rates are going to be. And they're talking about rate cuts this year. You've got the Bank of Canada that came out recently, again saying, look, we're not hiking and we're not yet easing, but, that conversation is shifting. It's shifting away from do we need more rate hikes to actually how long do we want to be on hold for, and therefore the next point is, well, when do we want to actually start cutting? That's the story for 2024. A lot of central banks coming into this year still worried about inflation, but talk of rate hikes, put that back in the back of your mind. That was for 2023. 2024 is, well, how long are we on hold for? And then, how long's a piece of string? But we think that piece of string, second half of this year, we'll see the Fed cutting, and then we think the RBNZ will be ready to cut by November. We had thought that they would be ready to do so by May, and that was simply thinking their last rate hike was in May last year. Give them 12 months and they'll probably turn around. Well, it's probably more likely to be 18 months and they'll turn around. So we are moving in the right direction, but with our discussion on non-tradables, there's still work to be done. It would be premature for them to cut in May, which is what we originally thought.
Yeah, I mean, I think that's a really interesting question. Is if that non-tradables inflation remains stubbornly high through another quarter, I mean, does that push out your expectation of when they cut the OCR?
Yeah, potentially. So we try not to muck around, going from May to August to November to slightly. No, actually, if we're going to change our call, we'll change it for, so we pushed it from May to November. We do think there is time over that period for us to get a few more inflation reads, obviously, a few more GDP prints and a few more rounds of forecasting from the central bank themselves, right? I think August will be quite an interesting time of year. February's obviously too early. May's probably too early, but I think by August we will see two more inflation prints. They could be softening us up for rate cuts by the end of the year.
So a couple of other things I'm keen to ask you about in New Zealand dollar, but also I guess just have a bit of a look at the global picture as we get into 2024. So firstly, the New Zealand dollar. What is your outlook there this year? I see it's around 60-ish US cents this morning. Where do you see that going?
So very near term, probably higher. There seems to be, a bit of a, the big dollar, the US dollar, has had a bit of strength. Could probably see that unwinding a little bit, and just given the fact that the RBNZ is not even contemplating cuts yet, I think can put a bit of upward pressure on the Kiwi, and where we are now, is not that high. I mean, we've been much higher, so I could imagine the Kiwi spiking a bit near term. But that's in discussion with our traders and what they're seeing and the flows that they're thinking about, it does feel like the Kiwi can bounce a little bit from here. But then when we look at the fundamentals, look at how interest rate differentials are likely to play out. So how high are our interest rates, compared to the US and others, and how that's likely to play out. I do think that there's downside risks to the Kiwi later this year. I do think that when the Reserve Bank does finally come in and start delivering cuts, that we'll see, the Kiwi coming under pressure. We had thought that the Kiwi would have ended last year much lower than it did. But again, we're looking for a lower Kiwi this year. But it is the most volatile of the top, 10, 11 most traded currencies, right? So we think, by the end of the year, we could see the Kiwi in the 50s, but geez, we'll trade in a 10 cent range, around that.
Yeah, it's a volatile one. And look, just at the international picture. So obviously, our key, as New Zealand, our key trading partners, Australia and China. So we're always interested in what's going on there. We've talked about the US interest rate outlook, which is obviously the key driver for global interest rates. There's also a presidential election in the US this year, which is, going to be, shall we say, interesting. And then, there's the horrors and human tragedy with the Israel-Hamas conflict and the Houthis attacking shipping in the Red Sea, and almost forgotten war in Ukraine still raging as well. Yeah. So when we put all these together, what's that telling you about 2024?
So the actual wars that we're seeing and we know about, and the ones that are hitting the press at least, there are a lot of other wars going on, but the ones that are hitting the press, they're inflationary, right? So when Russia invaded Ukraine, we saw what that did to commodity prices. That inflation in New Zealand is higher than it would have been had there not been a war in Ukraine, and now we're talking about disruptions in the Red Sea, and I think it's like 80% of ships being diverted around, adding time and cost to shipping. That gets passed on. Those higher costs and delays get passed on immediately. So we're seeing that here, and that'll come through into our inflation numbers. Some of it in the first quarter, which we're in right now, but probably most of it will feed through into the second quarter. So it's just another headache of prices being higher than where we imagined they would be. We thought shipping costs had normalised, right, and we really enjoyed watching the cost of shipping return to long-term averages, but now we're spiking again. So that doesn't help. So that's there. And then there's the risks of other flare-ups. China worries me. China has worried me for a long time, but China continues to worry me. Should they want to do something in the South China Sea, that really isn't in our backyard, and I don't know how we respond to that without hurting ourselves at the same time. So, they are our largest trading partner. If we get pulled into some sort of conflict between them and the US or however that plays out, China can punish us quite quickly by just simply saying, as they have done in the past, we won't send any tourists to New Zealand. Oh, by the way, that's your largest export. What's your second largest export? Oh, okay, well, we'll stop buying dairy. We'll stop buying this, that, the next. They can hurt us, and they can hurt us quite quickly. So that worries me. And then, there's geopolitical tensions elsewhere around the world as well. And you can't put these into any forecast scenarios, but when you think about scenarios, around what you're forecasting, these things do come up, and they are risks, and they're not nice, and they are inflationary risks, which, if we're getting inflation spikes due to wars around the world, central banks are supposed to look through that, and they try to, but when you have one shock after another shock after another shock after another, then, you get to a point where it's very hard to look through them all.
Yeah, absolutely. I think to sum all that up, it's not going to be a dull year, is it?
No, it never is, though, right? We always go into every year, and there's so much that can happen. I don't know. I'm always excited at this time of year of all the things that can potentially happen. But one thing in our jobs is it's never boring.
Yeah, no, absolutely. Well, look, Jarrod, thanks so much for that. That's Jarrod Kerr, Kiwibank Chief Economist, and I'm Gareth Vaughan from interest.co.nz with another of our Of Interest podcasts.